Hi, I'm Paul Morton with M-Advisor. This is M-Advisor Office Hours. One of the more foundational components to investing are stocks. There are two types of stocks, common stocks, and normally when the word stock is used, that's what's being described, and preferred stocks. Corporations can raise capital by issuing stocks. So in this example, ABC Company issues a certain number of stocks, usually based on market demand, and people and other businesses and corporations can buy those stocks, and it raises capital for ABC Company. In exchange, stockholders will have ownership of that company. Stockholders usually have a few rights. They have voting rights. There are company issue voting and board of directors to be voted on. There are rights to dividends, and a dividend is a fancy word for profit distribution, if profits are declared and distributed. They also have the right to sell or transfer ownership to somebody else. And typically the value of a stock or the price of a stock is determined by the market capitalization of a company, or the total value of a company, divided by the number of outstanding shares. Some stocks are listed on a stock exchange, such as the New York Stock Exchange or the NASDAQ. And so these stocks usually have a ready-made market, they're easy to sell, and they're considered marketable. Stocks that are not listed on these exchanges are called over-the-counter stocks, or OTC. These stocks are less marketable, and if somebody owns an OTC stock, then they want to sell it. It might take a little bit of time to find a buyer of that stock. The other type of stock is called a preferred stock. So the offering price, unlike the common stock, the price is determined based on the value of a company. Typically, preferred stocks almost always have $100 par value or offering price. These stocks are dividend paying. The reason somebody usually buys a preferred stock is to receive dividends or income. These are issued by mature companies. They are not looking to grow, but they are looking to distribute profits. There are no voting rights with preferred stocks, and they have a preferred liquidation treatment. So let's look at that. A liquidation schedule is if a company goes out of business, what happens to the remaining assets of that business? They would be liquidated to pay first taxes, then unpaid wages, then repay loans, debts, and bondholders, then preferred stockholders, and lastly, if there's anything left over, it would be distributed to the common stockholders. Thank you for listening. I'm Paul Morton with M-Advisor. This is M-Advisor Office Hours.